Some people think that Donald Trump is plain stupid, that he's destroying the economy because he doesn't know what he's doing. Others, however, think that he's playing 4D chess, right? That he might be putting pressure on China, or that he might want to force the Federal Reserve to lower interest rates. But in the end, I think the connections aren't really that hard to make. Trump is doing something that was way overdue. He's restructuring global trade. He's also restructuring the tax system in the US, and it's all because of the debt that the United States holds. Here is why the current system can't just continue the way it is. What we've got over here is the United States debt to GDP ratio. In red, we've got the gross federal debt, and in blue, we've got the debt held by the public. We are now at levels higher than what we saw at the end of World War II. And there is a limit to this ratio, because as the debt increases relative to the annual output of the economy, the interest rate payments go up as well. And at some point, those interest rate payments couldn't be served anymore without a hyperinflation of the US dollar. So the higher this is, the more the US dollar is at risk. Now, what does this have to do with trade and with tariffs? The answer is over here. This is a very long-term chart starting in 1800, and it shows the trade balance relative to the GDP of the United States. Up until the 70s, we tended to have positive trade balance. Since the 70s, we turned negative. Now have a look again at the debt to GDP. Since the 70s and 80s, the debt to GDP is rising. So as we had a trade balance deficit, the debt also went up. Now let's have a look at two data points over here. What did the US do over here to have such a massive trade surplus in 1915 roughly and in 1945? The answer is over here. The US supplied Europe with goods after the World Wars. Now, because Europe was completely destroyed and in ashes, and because the US could still continue to produce, there was all of that export happening that also then of course helped with the deficit. So the ideal scenario to get a trade balance surplus would of course be again an external war, so that America could help rebuild the country. But it seems like that's not really happening. The extent of the current wars, sort of the Gaza Strip and of Ukraine, are not comparable to the world wars. And so that might be the simple connection, right? As the trade balance gets equaled out, the debt to GDP might stop rising. Have a look at this. When there was trade surplus, the debt to GDP tended to go down. As we had trade deficits, the debt to GDP rose. Now, what does this have to do with asset prices? Now let's play with a straightforward theory. Let's say because the government is expanding its debt, because the monetary base is increasing, that should in theory mean that companies also can make more revenue and more profit. Thus, stocks should go up as indebtedness goes up, and as the monetary base is declining, we should rather see company profits going down, thus stocks going down as well. Now, is that what we see historically? At the top, we've got again the debt to GDP. And in red at the bottom, we've got the S&P 500 relative to the money supply. It appears as if the connection isn't really that strong. Yes, we saw debt contracting while at the same time stocks went down. But since the expansion of debt, we did not necessarily always see stock prices going up. We actually had our .com crash, and we then subsequently had the global financial crisis. How about stocks relative to the gold price? So that's now this line in white. It seems like stocks initially outperformed, then they crashed, then they outperformed again, they crashed again. There is no real connection between the debt to GDP of the US and the US stock market. So that's true relative to the gold price. It's also true relative to the monetary base. And so yes, short term, we did see stock prices coming down after the announcements of the tariffs, but I'm not sure if that's going to hold for long. I think fundamentally what's going on is simply that stocks are too expensive historically. When we buy stock, when we buy equity in a company, what we're essentially buying is the future earnings. And so a straightforward way to value a stock is just how many future earnings do we have to pay to buy the company today. That's measured over here. This chart starts in 1871, so this is 150 years of data. It's a 10-year moving average of all of the price to earnings ratios of the S&P 500, and it fluctuates in somewhat of a corridor. When we are single digit, we tend to be very, very cheap with stocks. But when we are above 30, we tend to be very expensive. And we are very close to 30. Seeing this retract back to say 15 would not be out of the ordinary. So stocks could, in theory, drop by 50% still from here. Crypto tends to be even more risk on than the stock market. And so we do see pretty much everything going down. And I think it's a mistake trying to find a winner in a market like this. It's not about asset selection. It's much more about figuring out where the macro is going. And yes, nobody has a crystal ball. Nobody knows where prices are going. But the current trend is pretty clear. Bitcoin dominance continues to rise. So more and more capital within crypto goes to Bitcoin, the least risky of the cryptocurrencies. And I believe that this will continue until we hit roughly 70% of all of crypto being Bitcoin. Once we are at those levels, the altcoins have a chance to outperform. But before that, we just continue climbing. And it seems like if we stay just at the current pace, that can take until the rest of 2025. So the current situation where altcoins are doing very poorly is probably going to last for a while. Now, since Bitcoin hit 100K in price, I am shorting the altcoins. I'm betting on falling prices of altcoins, and I have shared this continuously on this channel. Feel free to check out the videos at the time. Most finance YouTubers are always bullish. If the stock market drops, they say you have to buy. If Bitcoin goes down, they say you have to buy the dip. But I think it's better to just go with the general macro. And if the general macro currently says we are rather expensive in stocks and there is more and more outperformance of Bitcoin relative to the altcoins, then it does make sense to just be cautious as well and to bet on falling prices. It's much easier to make money in a bear market when most things go down than trying to find the few winners. And so we've been talking about this in the community as well. And here's one feedback I just got today. One of the members here made 785% with a short position. This is my best one today. I'm so happy with your strategy. I closed nearly all positions. What a result today. Thank you. So that's the kind of messages that you're probably not going to see in most other communities now. Here are a few trades that have been shared by various users. Right now, we are all making money. It's really not necessarily about trying to find winners in a market that's player versus player, where nothing is expanding. It's much more about adjusting the strategy based on the market conditions. When we are in a bull market, it makes sense to look for the few winners. It makes sense to try to buy the altcoins that make 5 or 10x returns. It makes sense to track other influencer wallets. But in a bear market, we want to do something else. In a bear market, we want to bet on falling prices. Now, the reason why most people still lose money during times like this, even though it's relatively straightforward, is because most people just don't want to short. Most people think it's too risky. There are these stories of people that get liquidated, that lose all of their funds by betting on falling prices. But that's only true if you don't know how to do proper risk management and if you don't know what altcoins to short. It's about finding the weakest of the altcoins. It's about finding the altcoins that expand very quickly in supply and where there's very little demand at the same time. To solve this knowledge gap, I've created more than 100 tutorial videos. So that's on on-chain analytics, it's on betting on falling prices, what platform to use, what kind of risk management to use, how to do portfolio management in general. More than 100 videos. Feel free to check it all out. Because so many people lost with this bear market, I've also reduced the rate from 165 to 125 per month. There's also a 1-week money back guarantee. So in case you don't like premium, just message me within the first 7 days and I'll refund you 100%. There's really zero risk for you. It's a mistake watching your portfolio doing this. Be active and bet on the right macro direction and do this with the proper coins and the proper setup. That's how you make money long term. And then in the end, the idea is to have more capital at the beginning of the next bull market. So that now we're just continuously growing with small trades. And then once we're at the end of the bear market, we can get in very heavily. If it's the first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube or see you in premium. Cheers.